latest World Economic Forum takes place in Davos, Switzerland, and will doubtless hog a lot of headlines in the coming week, and it will run all the way through from Monday the 15th to Friday the 19th of January. The theme is rebuilding trust, and 4 key issues will dominate the event: security and cooperation, jobs, climate, and perhaps not surprisingly, artificial intelligence. Now, some of you may find this jamboree a source of fascination. Others will view it as nothing more than a benefit for Swiss hoteliers and restaurateurs. Personally, I wouldn't open the curtains if it was taking place in my back garden, and the chances of anything big and market-moving coming out of it, from the admittedly narrow perspective of investment, seem pretty slim, at least if history is any guide. More tangibly, the latest round of jobs data from the UK's Office for National Statistics on Tuesday the 16th may merit further inspection, even if the ONS continues to experiment with its datasets. The latest batch of figures will cover the 3 months to December, and the base for comparison will be those for the 3 months to November, when the unemployment rate was 4.2%, still low by historic standards, but a half percentage point higher than 3.7% low seen at the start of 2023. Job vacancies fell by 45,000 to 949,000. That's down by more than a quarter from the spring 22 peak of 1.3 million. And wage growth provided the best news of all, even if the Bank of England may not have seen it that way, given its mandate to rein inflation back into its 2% target. Including bonuses, total pay grew 7.2% year on year, well ahead of the prevailing rate of inflation. In the new numbers, any further increase in unemployment, decrease in vacancies, and cooling in wage growth could all, perversely, be seen as good news by financial markets. Such a combination could give the Bank of England scope to pivot toward cutting interest rates. So far, Governor Andrew Bailey's pushed back on market expectations for 6 1/4 point rate cuts all the way down to 3.75% by Christmas, with markets seeing the first reduction in March. Any stickiness in wage inflation or strong gains in employment could give Mr. Bailey and the Monetary Policy Committee grounds for holding fire. On the corporate front, trading statements about Christmas and the end of 2023 will be the order of the day. 8 FTSE 100 firms will be issuing such updates, and Monday will be hosting a general meeting to seek approval for a special dividend payment. A number of small and mid-cap firms will also be offering updates. Names which may be worthy of further research include the following, pending any last-minute changes in the dates: Rio Tinto, Page Group and Ashmore on Monday the 15th of January, Ocado, Experian and Kinetic on the 16th, Diploma, Antofagasta, Galliford Try and Midwich on the 17th, Flutter, Sage, Currys, Elementis, Kia and N Brown on the 18th, and DFS Furniture, Petershill Partners and Frontier Development on Friday the 19th. But the company which could just cause the biggest fuss in the week ahead is Burberry. The iconic British luxury brand is due to release a third quarter and Christmas trading update on Friday the 19th. The shares suffered a torrid 2023, and they've fallen by a third over the past year to languish at 4-year lows. A weak recovery in the important Chinese market, broader concerns over luxury goods demand and so-called premiumization strategies, perhaps where the companies are starting to accidentally price out the more aspirational customer from the market, and also a disappointing outlook statement alongside November's interims have all contributed to the share price slide. Burberry's quarterly updates traditionally feature just headline sales figures, plus some more colour on trading. As a result, all attention will focus on the headline retail sales number, plus the like-for-like comparables. Analysts and investors will also look to weigh how these figures stack up against the medium-term targets outlined alongside May's full-year results last year by Chief Executive Officer Jonathan Ackroyd. Remember that those targets are high single-digit percentage revenue growth and an adjusted operating margin of around 20% on a constant exchange rate basis, and that compares to the 20.5% achieved in the year to March 2023. However, Mr. Ackroyd's already refined those goals for fiscal 2024, that's the year to March, and he did so back in November, when he flagged the global slowdown in luxury demand alongside the interim results. As a result, the CEO stated that if those trends were to continue, it will be difficult to achieve low double-digit sales growth for the year as previously expected, and adjusted operating profit will come in toward the low end of an admittedly very broad range of £552 million to £668 million. Analysts currently expect total sales of £3.1 billion for the full year and a stated operating profit of around £550 million. And that is with a forecast £110 million hit to sales and a £60 million hit to profits from currency movements. Adjust for that, an operating profit seen reaching £610 million for a margin of 19.7%. Analysts and investors will also look to compare momentum in the third quarter with that shown earlier. In the second quarter, comparable sales stores rose 10% year-on-year in Europe, the Middle East and Africa, advanced by 2% in Asia, and fell by 10% in the Americas. Analysts will no doubt also look for a progress report across retail, wholesale and licensing revenue streams, as well as additional colour on online versus physical sales, pricing and input costs. As a final point, remember that Burberry completed its £400 million share buyback programme back in October. Any updates on the company's capital allocation policy will be of interest. Hope that you and your families are all well and in good spirits. Thank you for watching, and I look forward to seeing you again next time.